All right. You guys are welcome. You're welcome to, actually, this is Risk Management 101. So I would say that because there's so many things about risk management that we need to learn. And today I want to begin sharing that thoughts with you on risk management today. So there are a lot of people coming in, joining in this Zoom class right now. And yeah, we'll be admitting them as soon as they join. But meanwhile, while we're waiting, this is a very important class that I want you to pay attention to. Good evening, everybody. You're welcome. You're welcome. You're welcome. So where are you watching us from? If you let us know, that'll be great. Who is watching? Where are you watching us from? I'm in UK. Who is watching us from where? Good, good, good. From Lagos. Wonderful. From Ghana. Yeah, GMT or GTM. JTM, sorry. Lagos, Ghana. Awesome. We have a lot of Ghanaians here from Lagos. Awesome. Yes, let us know where you're watching from the UK. Oh, yes, Adesami, sir. How are you, sir? Odisami. Yes, let's go, let's go, let's go, let's go. Let us know where you're watching from. Good, good. Let us know where you're watching from. All right. And then let others come in from Anna, bro. Well done, bro. Let's invite others and let them know that this is it, because somebody was accusing me that I don't help the group. I've never seen anyone done or do what I am doing in my group so far. So we are here to help, really. I'm here to help with the little I know. I'm not claiming I know anything much, but with the little I know, I'm here to help. So, and that's why there are things that people will pay for that I'm giving you for free. Why? Because you know what? This money is for everybody if we learn how to trade. That's what we want to do anyway, not to take from other people to enrich ourselves and then never care about others. So here we are. Okay, let's go. Much of the talking. Now, today I want to talk about risk management. So I wanted to pay attention to this. When we are talking about risk management, what are we looking at for? What are we looking at for? So there's a very brief introduction I want to bring to you in your mind. We are not going to go into chart patterns and everything else. No. That's not what we're talking about here today. We want to go strictly to risk management, okay? Risk management. And when you hear the word risk management, what does it mean to you? What comes to your mind? What comes to your mind when you hear the word risk management? Those are the things I want to bring to your attention. The first thing you want to think about is risk means how much you can afford to lose. That's what it stands for. It means how much can you afford to lose. That's why when we are talking about risk management, we look at, when we talk about trade generally, coming into the market and trading, we look at, you know what, we look at losses. We talk about what you can afford to lose first, because forex trading is not about just making money. Forex trading is about understanding how the market works in terms of your money, and then how to utilize the opportunity in the market to protect your money and then seize the opportunity to make profits. Okay, so this is what we're looking at. First, you want to think about what can I afford to lose? And that's the point. Then you want to think about how much. I think that's the second point. The first point is this. The first point is actually, how much do I have to trade with? How much do I have? How much do you have? How much do you have? So you want to think about how much do I have to trade with? That's a question. What's your balance? Then how much can you afford to lose on that? How much you have? We're talking about risk management now. Okay, how much can you afford to lose? So you're looking at, oh my God, I have some money. So great. How much can you afford to lose? Okay, then you want to look at how much do you want to make? How much as a profit now? How much do you want to make in profit? That's, and this would be based on percentage. That's what you're looking at. Based on percentage. How much are you willing? Now let's address this quickly. This is proper risk management, guys. I told you to invite others because this is it. I know it's going to be hard for so many of them to join in and participate this in this, but this is it. Now, let me bring it here so you can see it on the plane. So this is risk management, guys. These are the things that should come to your mind that you're thinking. Risk management. This is what you're thinking. First of all, so when it comes to how much you can afford to gain and lose, then you have to look at what is or what will be. So you want to look at what is your risk to reward, because you want to look at now what is the risk to reward ratio that you must stick with. You have to stick with it. What is your risk to reward ratio that you must stick with? Now, these are the things you want to think about first. So now let's break it down so that it will not be very complicated. Very simple things. How much do I have to trade now? Let's say you have in your account, you have some money and you have, like, in your account, you have $500. Okay, that's what you have to trade with. Very simple thing. You have to trade with this. You have some money with you, $75. I mean, $500. All right. You have $500 that you want to trade with. So the question now will not be, how much can I afford to lose? Question, out of this 500, how much do you think you are comfortable with? When you lose it, you are fine, you're comfortable with it. So it doesn't matter how much, but the point I want to address is your psychology here. How would you be feeling when you lose that amount? So you need to come to terms with it. Let's assume that you have $500 in your account. So can you lose $100 out of the $5 and be happy? And you still want to trade? Your psychology is not messed up. Or that is too big. Is it about maybe $50? Maybe that's too big. Is it about maybe $30? But it has to be based on, again, the percentage. So how much do you want to make in profit? Is it $30? Is it $40? Is it $50 on top of that particular account balance? Then the question will be, what percentage? Now, this is where I come in to address certain things with you about risk management. Now, if you are trading, now this video is going to be very brief, not too much of a thing. I want you to pay attention to this. Now, if you have an account that is funded, a minimum, which I have seen, is $10 to $500, or let me say $1,000. Okay, this is your account funds that you have. So let's say this is your account, and within this range, you are trading small accounts. So let me put it this way: to trade small account, this is very important to have this ratio. All right, small accounts. Sorry about that. Small accounts trading. That's what you're looking at. Now, I'm addressing small account now. What percentage can I afford to lose? In what range should I be calculating my losses and my gains? In what range? In what range? That's what you're thinking about. And I've always said, if you're being being part of my student, and it is not something that is it changed, this is fixed. You have to remember it, understand it. Now you're looking at within 30%, and I will explain why I'm starting with 30%. Within 30%, all right, sorry, to 5%. Now, why is that? I'll explain briefly. Because the higher the price, the amount, the balance, the lower your risk will be. The lower your balance below 100, the lower your risk, below 1,000, the lower your risk will be. So I want to pay attention to this. Look at this very carefully. Small account trading. So let's assume your balance is within this range. This is the percentage risk that you're going to look at for. In terms of losses and gains, first of all, losses. First of all, losses. Now, if you come to terms with it, in a very simple analysis, so you're looking at how much can I afford to lose when it comes to 500? If I was to have 500 in my account and I'm thinking, what percentage can I afford to lose? Maybe 5, maybe 10, maybe 15. So you have to come in agreement with yourself comfortably, something that will not mess up your psychology. Do you understand? This is very important. You don't want your psychology to be messed up. You want a situation whereby when you finish trading, even though you lose the trade, you will still come back tomorrow with some kind of confidence that I'm going to make my money back. Do you get what I'm saying? So what you want to look at for is this. First, out of 500, I can afford to risk 20%. Okay, 20%. That is $100. Can you afford to risk 20%? Is it going to be okay for you? If it is too much, then you cut it down. You say, okay, well, I'm going to cut it down to maybe 10%. So that's $50. So if you were choosing anything here within this range, let's say you go for 1,000, you have $500, like we already said. For example, we're giving an example. So we have $500, sorry, we have $500. And then you are looking at, okay, I want to actually multiply that. So we multiply it by what? 10%. So that's what you're looking at. So the 10% will give you what? You're looking at $50. So $50 will not be your risk. So the question is, how do you trade with this? How do you not trade with this? So this is for small account, all right? Now let me give you the parameters for big account. All right, I'll give you the parameters for big account. Now, the parameters for big account is this. You want to trade within this range of parameters. So first of all, how much? We're looking at a minimum. We're looking at a minimum of $1,000, a minimum of $1,000. All right. So we're looking at maybe $500K, $500,000, depend, 1 million. But this is the range. I want to pay attention to this. We're looking at 500K in dollars, right? As big as the account will get, right? But what is the percentage range that you should be looking at for? What is the percentage range that you should be looking at for? So the maximum you can trade this is 2%. And I want you to pay attention to this. The maximum you can trade is 2% on any of these accounts. And the lowest you can go, you are allowed to go, is 0.5. All right, 0.5. So what does that mean? Again, the lower the price, the balance, the higher the percentage. The higher your balance, the lower your percentage. You say, why is that? Is it not supposed to be the higher your balance, the higher your percentage? No. When it comes to trading, risk management, that's why we call it risk management. That's why you're learning it now. Because what we used to do is to do it the opposite way. So once we have big money, we start risking more. No, it is when you have big money, you start risking little. you start trying out to risk little because you start accumulating small gains. And then before long, it will become very big. Now, I will show you why this is very important in terms of trading. Now, don't forget what I just showed you here. I want you to pay attention to this. So if you're taking notes, take this down. This is the best place that you want to take something down. So for example, let's say, for example, you have, let's say you have 100K. This is $100,000. All right. That's $100,000 in dollars. That's what you have. Okay. I know a lot of people are still trying to come in, and then some of you are sending link to go on, send invitations to them to come in as well. So let's say you have 100K, all right, that's $100,000, and you're planning to risk 0.5. Okay, that's what you're planning to risk. So you're planning to risk 0.5. So that would be 0.0. So that means at this point of time, what you're looking at to do is to risk 0.05. Okay, that is the percentage you are risking. That's what 0.5 means. Okay, that's the percentage you are risking. So what will this give you? This will tell you that you are risking 5,000 in the market, because that is exactly what the market is saying. You're risking 5,000 in the market. Are we together? So right now, your risk, you're saying that if you lose out of your trade, you're ready to, can you afford this 5,000? You see, in $100,000 account, 5,000 is nothing to you. You see, it's nothing, but it's much. Again, it looks much. Why you're using? Imagine now you're using just the higher the money goes, you're using a smaller percentage. But then you see the difference. So let's assume we're using 1%. If we were to use 1%, let's say we're using 1%, that's $10, $10,000. So if we're to use 1%, that means you're risking $10,000. All right, that's $10,000. 1%. Sorry, that's 10%. Sorry, I'm using 10%. That's not 1%. That's 0.01. Sorry. So 0.01 is 1%. So actually, I missed it there. I missed my calculation there. Sorry about that, guys. So 5% would be, so 0.01 now. All right, that's 1%. That would be what? $1,000. That's what you're losing. Okay, that's what you're trading under 100K. Now, when you have 0.5, when you have 5%, then you are risking $500. Okay, that's what it means. $500 on this, not 5,000. That's $500. So that is small to you. That is small. All right, it looks small, but that is exactly what risk management will give to you. So at this moment, we're looking for 0.5, all right, 0.05. So this is what we're looking at, $500. So at this moment, what you want to think about is, how do I implement this in my trading? So I'm just giving an example, all right? So let's say this is what you're looking at. The first thing you want to think about is, have you followed these rules? How much do I have to trade with? How much can I afford to lose? You have to settle this. How much do you have to trade with? How much can you afford to lose? If you don't settle these in your mind, don't get into a trade. You need to, you see, that's what you have to focus on, your losses first before you think about profit. And I will explain why this is very important in a minute. I want you to think on this. Have you been trading like this, thinking like this every day? I mean, you come to the market, you know how much you have in your balance. Let's say you started an account here in the beginning of the week with $500, and now you're having $300. $200 off in losses in 1 week. This is time to think. Am I following my risk management? What is going on? How much do I have now left in my account? 300. How much can I afford to lose now? Can I afford to lose any? If it is not up to $50, $30, or $20, you make up your mind. You have to think and accept it. And then one of the things that we face is not that we have problem with our strategy. A lot of us have strategy. We have, YouTube is full of strategies. You're looking for a lot of trading strategy, you'll find millions. And until you are tired, you're confused. Strategy is not your problem. Entering and exit is not the problem. The problem actually is when you are not trading, how do you manage your risk? We don't choose when we start trading how much we can afford to lose. We don't decide. We just go on and start trading. We don't decide. Actually, we decide how much we want to make instead of how much we can afford to lose. You see, we're looking at how much do you want to make in profit? Man, I want to make 10%. I want to make 20%. We're looking at how much we can make. We're not thinking that that same percentage we're thinking to make is equivalent to the percentage that we will be losing if we lose the trade. You see, the question is, can you afford to lose 10% of your account in a day? You're not thinking like that. But you're only thinking, I want to make 10% today. I want to make 5%. Question, can you afford to lose 5% of your account in a day? That's the question. Until you stick that in your mind and make it deep in your heart, in your mind, in your thoughts, in your psychology. You get it? In your psychology, it had to be deep in your psychology. Otherwise, you'll be missing it. You will be missing it, trust me. That's why a lot of people, that's why they lose account, they blow account over and over again, over and over again. Now, let's move. How do you implement this on your trade? Remember, when we are trading in Forex, we trade in lots. Okay, we trade in lots. And I believe most of you now understand your lots, right? Let me explain that briefly. Now, when you are trading in one standard lot, one standard represents, I'll just put one there so you know, one standard represents $100,000 lots. That's what you're trading with, $100,000 lot. So 1.5 definitely will be what? It will be $150,000. That's the lot that you are giving. So your money may not be up to this in your account, but your leverage will allow this to happen, depending on the leverage that you have. So some of you deal, let me just start with that for a moment. Let's say you have a leverage of 1 to, your broker gave you a leverage of 1 to 500 or 1 to what? 100, all right? What does that mean? It means that in your trade, you can only go per trade, you can only go into your account, into your trade in 100,000 lots. That means one standard. You have to go into your account in 100,000 lots. And sometimes, no, I think this is, this is 1 to 10 is 100,000. So this is like 1 to 10, all right? This is 100,000. 1 to 50, like this, is about 500,000, okay? Don't forget, leverage, okay? So when you have 1 to 100, that's about 1 million. So your leverage, so for example, you have my Forex fund account, and they say 1 to 100 leverage. That means that your capacity for leverage is about $1 million. Are you getting it now? Those that give you 500, they're telling you that the capacity to that account is about that much, depending. So for instance, I'm saying if I have an $100,000 account, so depending on what you have, if you have 10,000 times this 500, that's what you get. Whatever account balance you have. For instance, if you have 30,000, so if you have $100 in your account, if you have your leverage like this, you have to multiply that 100,000 by this 500. That's what they're saying. So that's the way you have to think about leverage. So you have to look at your leverage first. How much space do you have in your account? in your allowance, what the broker is giving you. Very important. And then now you want to look at the lots. So let's look at the lots. This is what we're looking at, the lots. So you have one standard, you have 0.1. 0.1. Now, when you have 0.1, you are dealing in what? In tens of tens. This is 10,000. You're dealing in tens of tens of thousands. So if I have a lot size that is 0.2, what does that mean? It means 20,000 allowance given to me. So that means if I enter a lot like this, I'm buying a lot size of 20,000. So you need to understand your lots. You need to know why. So you have the micro or mini lots. We have this micro lot. We have mini lots. So the mini lot is 0.01. So what does that mean? This represents 1,000. 1,000. That's the highest lot you can take on that. 1,000. So if you have any, you can't go less than this. There's nothing like 500 lots. It doesn't happen in Forex. The least you can go is 0.01. So when you are trading like this, you're trading these lots. So you must understand this first based on the account that you're using. So when somebody have 20 standard lots to trade, that means you are, can you imagine? That means you are trading what? 200 million. That's obviously, how much is that? Maybe 2 million. All right, that's a lot. I may not be on top of my calculations right now, but that is a lot. You need to do your maths. But right now, here is the trick, guys. Here is the trick. You need to understand how to now implement all of this calculation in your trading. And that's why we will want to introduce you to Baby Pips calculator, which is online on web. So this one is just right here, online web. So you have it right this. So this is Baby Pips, babypips.com. All right, you come here and you click on tools, you come to position size, and it gives you this. So this is what you see. All right. Of course, I have some writing here, obviously, just to help you remember what I've just said. So we'll take example of those things there. Now, look at this, guys. Pay attention to this. What did he say? Account currency. What account currency do you have? Is it US dollars or any other currency? You choose your currency that they allowed. These are the major currency that they allowed around the world. So normally everyone chooses USD. So what is your balance? Like I said, the first question you want to ask, how much do I have to trade with? Let's say you have $10,000 in your account. The question will now be what range. You see, now you're thinking, what range? Let's go back to our chart. What range now? Where is it? It's still here. So now what range? What range of currency, what range of percentage do we have? Is it small account or big account? It is in the class of big account. Okay, so we look at the percentage now. We say anything from 1,000 to 500K, right? So remember we said that the lower the amount, the higher your percentage will be. So the lower the higher the amount, the lower the percentage will be. So the smaller the account, the higher the percentage. So you understand what I'm trying to say. It's very important not to miss me here, because I'm trying to say a lot of things out in a very short time that we have. This class we're teaching now is something that I do for 1 week for my student. 1 week. I mean, if I have them 1 week. So this thing, I mean, 1 week means 5 different classes. I teach risk management, 5 different classes. So you don't understand that if I'm trying to put everything now into one place in less than an hour, I'm gonna be rushing. That's why you see me talking over and trying to repeat words, or I mean speed things up. Okay, now $10,000 risk management. Remember. So now this one is your choice. You have to choose what you are comfortable with. This one, I'm not going to tell you that this is what you use. I gave you a range as a trader, what you can play around with based on your emotion, based on your psychology. You want to play around with these figures. The question is, can you afford to lose what percentage? If I say, okay, I'm going for 5%, that's too high because I don't have 5% in the range. I only have the highest is 2%. So what? Let's say I'm going for 1%. I'm risking 1% of my account, period. So I'm risking 1% of my account. Just a minute. I'm risking 1% of my account. Then what? What stop loss do I need? Now here, I want you to follow this now. Follow this. This is the key. Stop loss. What stop loss? What do you mean stop loss? It means if I choose like 10 pips and every stop loss must be in pips. Remember, Forex is calculated in pips and pipettes. Okay, it's calculated in pips and pipettes. You have to do your business. You understand that? So now the movement of price from one price zone to another price zone can be ranged in pips. So let's say price move in 10 pips in your favor or against you. How do you know? But right now you're looking at your losses. Did you notice that they never said take profit? They never gave you take profit. They only said stop loss, because in Forex, you have to be concerned about how much you're willing to lose first before you think about how much you're thinking to gain. You get it? How much you want to make. You think about your losses first. So now this man is this calculator is telling us we should think about our losses first. So I'm losing 1%. I'm risking 1% to lose 1% of my account at 10 pips stop against me minus. So I will choose my GDP USD, whatever pair you choose, you trade. Anyone is a lot of them here. You choose the one that you want. I trade GDP USD for now. And I calculate. Now, let me remove all of this, because if I remove these things, I believe you guys have written it down. I'm not going to come back to it to write it down. So one way or the other, you got to find a way to write it. Okay. I'm going to, because it's obstructing what I'm doing now. So I need to take it off. All right. There we go. Okay. Now I hit calculate. Look at what price gave me. So it's telling me out of 10,000. Okay. I'm risking $100. So if I lose $100 in a day, would I be happy? Would I be comfortable with my trade? Would it be okay for me to come back tomorrow to trade under when I have $10,000? Then what are my feelings going to be like? If that is too much, then break it down. For you, you say it's too much, then break it down and say what is $50. I'm risking $50 in this first trade. So now, what does that mean? The computer will calculate position size. You see, every 0.5%, I mean 0.5, which is less than 1%, half of 1% is this amount. So it says the standard lot of the position size is 0.5, which is 50,000 lots. Remember, I said 0.1 is what? Is 10,000 lots. 0.01 is 1,000 lots. So now it says 0.5, which means 50,000 lots that you are acquiring. So even though you have an account of 10,000, these lots can only acquire 50,000. So you see why leverage comes in. So you are not actually buying with this account. You are buying with the broker's account with money. So that means your deposit for this $50,000 or 50,000 lots is $50. That's your deposit. Do you get it now? So this, then you now have a balance of what? Minus $50. So you now have $9,950 in your account as your balance or as your equity. Equity now at that moment once you enter a trade. Okay, so that's what they are saying. So that appears as your equity. So right now, what you want to do is to use this. So the question is now, how does this work? How does this work? Very simple. What does this mean? 10 pip stop loss. What does this mean? What does this mean? I'll explain. This is the amount of risk that you're losing. So it means if I enter a trade here to the downside to sell, and I put my stop loss at 10 pips, all right? That's stop loss. Then what they are saying is, according to this, that if price goes up against you and hits this level of price, which is 10 pips at the price range, 10 pip, that movement 10 pip to a price range, then you will be having minus $50 in your account. Your deposit will be taken. But if price moves to your favor in another 10 pips, that's what that 10 pips mean. In another 10 pips. So you have plus $50 in your account. So what does this mean? This will not tell you what we mean by 1-to-1 risk to reward ratio. This is what it means. Arrow, arrow. All right? 1-to-1 risk to reward. It means you are risking 10 pips, which is equivalent to $50 of 50% of your account. Therefore, if price goes against you, you lose it. Bam. Minus. But if you go, price goes in your direction from your entry point and drop into take peak, 10 pips take profit, that means you have made $50 for that trade. You see it now? Now, with this structure in place, it is easy for you to gradually build confidence without actually blowing your account. Why? Because already, if you see price moving against you, and then it's almost getting to your take profit. Let's say here, price was in 8 pip. Why would you wait for it to hit 10 before you close? It makes no sense. I always tell people, it makes no sense. Why would you wait? You can still cut down your losses. Let's say price is moving already 6 pips or 7 pips against you. You can see, you don't need to wait for that 10 pips to hit before you get out. You cut down your losses and wait for a better position to get your entry. So with that regard, instead of losing $50 by letting it hit, you can eventually lose maybe $30 instead of $50. You can eventually lose maybe $25 instead of $50. How about that? Which one is better? This is what we call risk management. You have to learn to manage it. This risk, you manage it. If price is going against you, bam, bam, and you have entered 0.5 lots on your account, one entry, you enter 0.5 lot, you know price is going against you already. Why must you wait for it to hit stop loss? You can see price have already taken 5 pips away, $25 minus, and it's going $30 minus, and you see it's still going. The momentum that the price is pushing up is heavy. You can see the bullish candle printing, and you left it. What kind of a trader are you? This is where the problem is with many people. They will wait for it to hit. Can't you see the momentum? Can't you see the bullish candle pushing up? Can't you see? Must you wait for it to hit? Yes. If it doesn't hit, you are not a trader. No, that's not what it means. It means you are not, you don't understand risk management, period. You cut down your losses. Why not save $10 instead of 50, losing 50? Why not save $10 out of it? Why not save $25 out of it? Why not save $20 out of it and wait for a better position to enter the trade and sell? The same thing. Let's look at the positive side. Let's say price is going for your favor now, and then is in 5 pips in your favor. What does that mean? $25 plus. Guess what? Your mind is excited. You're feeling the vibes. And then it hits 10 pips. You did not take profit. It was what? $50. Guess what you do? John, don't annotate. All right, no one should annotate, please. Now you take $50. You already hit $50. You didn't take profit. You know what you did? You left it. Price was still dropping and it got to $55. You did not take profit. Price was still dropping. It got to $60. You say, man, I'm making money. Let me just leave it. It will still drop. As though you are the market maker. It will still drop. Your risk reward was 1-to-1. You didn't take. Now, risk reward has hit 1-to-1.5. You did not take. You are now in risk reward 1-to-1. All right? 0.5. You did not take profit. Your risk reward is still moving. And then all of a sudden, price changed direction. It started going up. From $60 that you have is now 50. 50 to 49. 49 to 35 plus. You still didn't take profit. Oh, you left it. You say, it's a retracement. It's going to drop. You are not a swing trader. You are a scalper stroke intraday trader. You know you're supposed to take profit right off. You didn't. Guess what? Price pushed back up again. And then price started reducing until it goes back to entry. You are now back to what? -1, -10,000, -$10. You have -$10. And then you're now thinking, oh man, I should have taken my profit. Why? Our price just retraced. It didn't come back. And guess what? You close trade out of fear. You don't want any more losses. Then you now close trade when it was -$20. Who is now a fool? Is it the market or the one who is trading it? Why? Because there is no proper understanding of risk management. So this is exactly why education is so important when it comes to risk management. Now, I'm using this as an example to give you a heads up. Listen, it's easy to manage your account and not blow your account, and you still be in a trading market and be trading. Now, assuming now, looking at this 1-to-1 risk to reward market gave me, and I'm in profit. What am I supposed to do? If I don't want to close, if I still see that the momentum to the downside is still very huge, it's powerful, and I don't want to close, what do? I would take 80% of my profit off the market, off the table, and I will leave the rest in profit to run. What does that mean? It means that if I enter the trade here, okay, and I'm selling and I've hit take profit of 1-to-1, I will move my stop loss, take half of it. That means you see this loss size here. All right, 80% of that will be what? 80% of that will be 0.3. You would take 0.3 off the market as profit. You will leave 0.2 to run, and this 0.2 that is left in your loss size, you will put it in break even. That means you will put your stop loss above it. If price like here, this is the take profit here, so you will move your stop loss where you enter. This is your entry, this is your take profit. So you will move your stop loss from here and move it here to break even and let the rest run. So even though price retrace without you knowing and hit you at the stop loss, you will still be in profit. Why? Because you have already taken 80% of your trade off the market in profit when price was in your favor. 1-to-1 risk to reward. So if price now end in 1-to-2 risk to reward ratio before retracing, you will still have extra money from that 0.3 lot that you left in the, 0.2 lots that you left on your trade, which is 20% that you left. So you took 80% off the table and you left 20% to run. If you would do this at every time, that means don't set outrageous risk to reward. Some of you guys are funny. You are targeting 1-to-3 risk to reward. You don't even know how to trade yet. And when price doesn't hit 1-to-3 risk to reward and it starts reversing in 1-to-2 or 1-to-1.5, price gets to 1-to-1.5 and start retracing back up or whatever direction, it start retracing against you. You thought, oh, it didn't hit my take profit, so I just left it. What do you mean? Is it a competition? You are here to make money. Price gave you 1 to 1, 1 to 1.5 profit. You didn't take it. Then you are greedy. That's the simple truth. That's greediness. So you need to understand this. Now, let's go back to the chart quickly as we round it up quickly. Now, let's go back to the chart. With all of this I've explained, how would you have implemented? Very simple. You go back to the chart. All right, look at this trade right here. Let's use this trade that just happened as an example, okay? And I'm going to pull out my buy order, okay? I'm pulling out my buy order on a long. So, for instance, if I was entering this trade, I will not enter until this candle broke above here. This is when I will enter the trade here, all right? That's when I will enter. You say, wow, so you miss all of this entry. Yes, sometimes you have to be very sensitive. You have to be wise. I'm not looking at what I am missing. I'm looking at how many people I can take out of the market and make profit. Now, let me explain something to you. You see this order box that you see here, this order box for buy, I double click it. Okay, I want to show you something, how you can easily use it to work things out for you. $500, that's what I'm risking, or let's say $10,000. So I put the amount there, $10,000 amount size. So what is the loss size? First of all, you look at the risk. What are you risking? I'm risking what? 0.5, right? That's what I'm risking. I'm risking 0.5. So what does that mean? It means that first, what loss size am I using? The loss size that I got there was what? 0.5. That's my loss size. Remember, guys, 0.5. That's my loss size. So 10,000. 0.5 loss size. That's what I was giving because I was risking 0.5. That means 5%. Okay. Now, I'm going to set my entry based on that parameters. I will say, okay. Now, look at the parameters. What were my stop loss? My stop loss was 10 pips. Right there. I move it and I move it to 10 pips. That was what I said. And then what? My risk to reward ratio is 1 to 3, 1 to 1. First, 1 to 1. Look at it. I want you to look. 1 to 1. There. Look at how amount. Look at the amount if you lose. I want you to look at this amount, guys. Don't miss me here. We enter 10,000. Look at this amount when you lose. Look at this amount when you gain. And I want you to look at how many pip. This is 10 pip. Right now, movement. This is 10 pip movement. Just to show you how easy for you to make small money in any trade. How easy for you to make money. Very easy. Look at this. You see the amount here? That is 10,000. All right, $50. You see the amount here? This is $9,950. Okay, so what does that mean? If you lose, if price push down and hits this line, this price line, which is your stop loss, this is your stop loss price, and this is your take profit price, risk 1 to 1. Okay, if price come here and hit this, what do? You lose $50. This is minus $50. Now price move up and hit our take profit. Guess what? When price is pushing up like this, all I need to do is to go to my MT4, MT5, and I will take profit because I'm looking, each candle is printed in 15 minutes. So you can already tell that price is getting to your take profit. You can see it. So I will leave this, my take profit open. I will not put the price there, but I must ensure that my stop loss is put there. I have to put my stop loss on the MT4, MT5 I'm trading with. I'll put it there. My stop loss is very important. I will leave my take profit open, but I'm monitoring when it's going to hit 1 to 1 on my trading view. Immediately it hits 1 to 1 risk to reward, I will go to my MT4 and take away. That means I will take profit of 80% out of the market. What do I do next? Here's where the trick is, guys. Here's where the trick is. The trick is this. You see where this line is? All right. You will not extend it to the upside. You target another 1 to 1 again. Put it up. And then at this moment, your your stop loss, you will move it up and then break even above where you had it. So you now have your stop loss over there, something like this. This is what your trade will now look like. So that means you have taken profit and your entry is right here. Remember, your entry is at this zone. This is your entry zone here. All right, that was your entry. So right now you have broken even in profits. So your stop loss is above it. Now, whatever is left that is running now, according to this trade, like it moved up like this, this is extra money on your account. This is not extra, and yet is in profit. So you just leave it and let it run, and then take profit whenever you see the red candle like this now. By this time, you should have taken profit. Why? I would take profit on the next candle, even before he started printing the next candle, because I know this is my zone of reversal zone for me. So I'll take profit right there. I'm out. As simple as this. A lot of people don't stick with this. Now, this is what risk management entails. And the bigger the account or the differentiation of the account that you have, the more you're going to have those challenges of choosing the right risk management and managing it. It's very important. Okay, I think I've said a lot and I've said enough concerning risk management. Now, I'm going to just do a recap. First, you have to think about how much you have in your account to trade with. And then you must think about what you can afford to lose based on percentage. And then you must think of how much do you want to profit. You have to look at it in terms of percentage and risk to reward ratio. And you will have to stick to that for a while to practice and have discipline for yourself. So when you do that, it's very simple. So remember, our calculator is a baby pips. You can come here and put in the figures of what you want to trade. Choose the percentage of risk, which we have given to you, both on big accounts and small accounts, and then select your stop loss. So if I choose 20 pips, for instance, as stop loss, and I hit calculate, do you see that the standard loss side will change from 0.5 to 0.25? What does that mean? It means it will still give us the same amount of money, but we will be using smaller loss size because we increase our risk measure. So immediately we increase our risk, the standard loss side will reduce. If we reduce our risk, it will increase. So always look at what is giving you. For instance, if I say 15 pips, enter, you see it change. The loss size has changed, 0.3. You see that now? But it will still amount to the same money. Why? Because what you're saying is, I want to give more room for my account, for my trade to play out. So what? If it's going to hit 15 pips, I will still be losing. If I enter my trade, I will still be losing $50 anyway on 0.3. It's different when some of you would like to trade. You will enter 0.3 at this loss size, and then you will enter it in 4 position. You have over risk your account. It's no more this risk. You have over risk. This is over risk. This is trading outside risk management. So you now have 0.3 times 4. That is not part of the plan. That is not part of the plan. This is over risking. You stick to this first and ensure you make your profit first. So that means what you're doing is you are targeting more and you are risking more. Okay? But because you're targeting more, that's why you wanted to, trade with that standard lot, because you want to make more money. But the reality is that which you are risking to make, or what you are targeting to make more, is the same thing that you are going to be risking at the same time. So that means if you multiply this by 4, it's the same losses. This one will be multiplied again. This one now will be times 4. So you now have $200 to lose. So that's why you see some of you, you enter a trade, Instead of you started with like, I'm going to lose $50. If I lose $50, I'll get out. Then you end up losing $200 instead of $50. Why? Because you risk too much and then you break the rule. So yeah, I think that is enough for now, because if you want to take the full detail on how to trade using proper risk management and stacking, you better get in touch with me. And for more information, guys, for those of you who will be interested in the food training that is coming up in June, we're going to be having a training in June. We're going to be having a training in June massively. It's going to be massive. So it's going to be the normal monthly training section, but we're approaching it in a different way this time. So if you're interested in it, get ready and save for it. You have to save for it. It's not for free. This training is not for free. We take about 2 weeks to train you, and the price this time is different. It's no more $50. So sorry, you got to be ready. For those who are ready, even though just 2 people, 3 people I can get to train, is better. Now get ready for that, because I'm giving you a lot of information for free. So get ready. All right, by June. So if you are not following us on the Telegram, follow us. If you are not following us on the YouTube, follow us, because that's where this information will be released. Thank you guys for watching. I believe you learned so much on this particular training on risk management. If you will put this thing to work, you will be surprised how you'll be just making money and then not losing. Really, your losses will cut down to almost 100%. You'll be surprised that the little you'll be losing, it will make nothing to you. But when you make money, you'll be covering your losses big time. So yeah, that's what we want to do, and we want to help you do that.